of the total amount of the funds needed to be used for payroll. It was originally 75%. They reduced that to 60%. And as long as you meet that requirement, basically you can get full forgiveness here. So that's really the extent of the easy form, entering those in if you did meet the initial qualifications there. And the extended form is very similar. Same information here. The only difference is adding in the reduction of the forgivable amount based on the salary or hourly wage reduction or the full-time equivalent employee reduction here on the number of employees. So if those were reduced, then it will reduce the total amount of the loan proceeds here that were used for these qualifying expenses. We'll reduce that here and then have a similar calculation. Still needs to meet 60% requirement for payroll costs. And then you'll have your forgivable amount of the loan here. So both of the applications are very similar. Back to that. So as far as required documentation, payroll, like we said, needs to make up 60% of the use of the funds. And we will need to actually submit the tax forms 941 in most cases, that cover the quarters for the covered periods. So that will show the total wages paid and taxes paid and all the relevant information there. If you do use a third-party payroll vendor that, for example, employee leasing, if they submit all of those forms on your behalf and there's not a separate Form 941 for your business, they will accept the detailed reports from those third-party payroll providers. So the full-time equivalent calculation, we're going to go into this in a little bit more detail with Candace in just a minute. But in short, the full-time equivalent, so your full-time employees or full-time equivalent employees, if you have part-time employees, needed to stay the same during the covered period, either the 8-week period or the 24-week period, whichever was chosen for the disbursement of the funds. Mortgage interest.
Speaker at the bottom, if there's a speaker with a little X through it.
What's that? So mortgage interest can be any business interest that is specifically, it doesn't necessarily have to be tied to a property, a building. It can be business equipment or other business interest. It is only the interest amount of the payment and not the full amount of the payment that qualifies for use of the funds. So any interest that was paid during that period can be forgivable. Rent or lease payments also qualify. There are some stipulations as far as related party lease payments. We'll go into detail on that on the next page. So any rent obligation that was entered into before February 15th of 2020, those rent payments are qualifying expenses. Also business utility payments. So as far as documentation for business utility payments, we will need to show invoices for the utilities paid and a copy of the canceled check. And for rent or lease payments, we will need to provide a copy of the lease agreement and then also a canceled check showing the payment was actually made during the covered period.
Chad, one thing with the leases, we are going to talk about self-leasing where the owner of the operating company is also the owner of the property that's being leased. I know with a lot of business owners, they have these leases in place, but they don't have lease agreements set up. So that would be a good idea to have the lease agreements in place if that is a requirement for documentation of the forgiveness.
Yeah, thanks, Doug. And as we mentioned before, so if the owner of the property, if the business owner also owns the property that is rented, that would qualify, that would fall under the related party rent. And it is allowed, but it's limited to the actual mortgage interest paid on the property. So in that case where it's related party, it's not the full rent payment. If you're paying it to a third party and you pay, you know, in this example, $2,500 a month, the full $2,500 a month would qualify as a forgivable expense. But if it's related party, it would only be the of that amount. So in this case, if say $500 of the rental payment, that's the amount that would qualify as a forgivable expense. And I wanted to jump back to utilities. So that's pretty broad. We will need to show an invoice for the utilities and then the actual canceled check. That does include, you know, your standard utilities, electricity, water, gas, telephone, internet. It also mentions transportation, and they clarify that fuel used when driving a business vehicle is transportation expense, and that can qualify. So any fuel that's used in a business vehicle during that covered period, you need to have actual receipts and substantiate that expense, but that will qualify for utilities expense and be a qualifying expense. Okay. Well, I'll turn the time over to Candace.
Any questions so far? Now we're getting into numbers, so just eat your sandwich, eat your burger, don't pay attention. No, I'm just kidding. So accrued interest, if you do not receive 100% forgiveness of your PPP loan, you will have to pay interest from the time that you received the loan. So if you received it in April, it would be from your accrued interest on the unforgiven amount from that date forward. The lenders will not be requiring any loan payments until the SBA has actually approved or denied your forgiveness and actually paid off the portion that is forgiven. So if I got a $200,000 PPP loan on April 10th, and only $100,000 of that is going to be forgiven, the SBA pays that $100,000 on September 10th. I would still owe interest from April 10th to September 10th on just the $100,000 that is not forgiven. But the lenders will be communicating that to you as well. So some of the key terms that have just recently been defined is owner-employee. So owner-employee affects a lot of our S corporation clients here. I know that. And that an owner-employee is someone who owns the company and then also receives a W-2 wage. So an owner-employee, there's some restrictions on the amount of wages that will be forgiven. That's separate from a traditional employee. So one thing that has been clarified is that if you're less than a 5% owner, you're not subject to the owner-employee rule. So if you don't know, they did extend the amount of time you have to spend your PPP loan. You can spend it in an 8-week period, or you can spend it up to 24 weeks or the end of the year. You can cut off that period at any time when you reach a point where you've used all of your PPP funds. So when we talk about owner-employee, an owner-employee has the same limits here on the 8-week period as a traditional employee. But if you extend out to 24 weeks, you'll see that an owner employee's amount of forgivable wages is maxed at $20,833. So in those cases, not as much of your salary is being able to be forgiven. Additionally, they are also limited to what they paid in prior years. Unless, of course, you're a new business that started between January and February of 2020, then this would not apply to you because you were not in business. So that limitation is your 2019 salary times by 2.5 months divided by 12 months. So you're limited to that amount. Some other things that are part of the payroll cost calculation are things like health insurance and retirement and state and local taxes. So this chart kind of gives you an idea of whether or not they're also eligible to be forgiven. So if I'm a self-employed individual, don't worry too much because most of our self-employed individuals are getting 100% forgiveness. The exception would be those that are self-employed that also have employees. You need to make sure you do that extra calculation. If you're a general partnership, those PPP loans were calculated on your self-employment income. So all these additional type deductions don't qualify you either. But typically in a general partnership, you're not getting a retirement payment or those type of things. So the third one is the S-Corp owner employee. So an S-Corp owner employee, you're not allowed to tack on to that base salary wage forgiveness, the health insurance. And that's because you can include your self-employed health insurance on your W-2, which then makes it wage compensation. You are able to do retirement. So if your business has a 401k plan and they do a 3% company match, that 3% would be eligible to be totaled in the payroll costs and be forgiven. Questions so far? Any questions?
I can't see any in the chat.
Okay. So full-time equivalents. I won't get too crazy because I know you're not as nutty about numbers as I am. One full-time equivalent equals a person who works 40 hours a week or more. So if someone always works 40 hours, they're always counted as one person. They're never more than one person. The people who are tricky are the employees that work less than 40 hours. So if you have employees that work less than 40 hours, you can take a work week. You would remove all the people that work 40 hours or more, take just the part-time people's hours, add them all together, and divide it by 40. And that will give you your full-time equivalents. So if you had 5 traditional full-time employees, and then you accumulated all your part-time employees, then you would add them together to get the total full-time equivalents. The other calculation you can use is you can say that I take out my people that are full-time equivalents who are automatically counted as one, and I can just give any part-time people a 0.5 full-time equivalency. So you can just say automatically, if I know I have 5 part-time people, I would automatically get 2.5 full-time equivalents. But you have to be consistent. You have to use either option 1 or option 2 on both your base period determining full-time equivalents and during your covered period full-time equivalents. So if you find out that during your base period that you had 5 full-time equivalents, and then you calculate during your covered period that you only have 4 full-time equivalents, you will not receive 100% PPP loan forgiveness. So that's why it's important to calculate them the same way when you're calculating both the base period and the covered period, and then determining that. So the periods, which is which? So the base period can be from February 15th, 2019 through June 30th, 2019, or it can be from January 1st, 2020 to February 29th of 2020. Or if you're a seasonal employer, it can be any 12-week period from May to September of last year. So you can ask, okay, which one should I use? That's gonna really depend on your business. So I suggest that you calculate both of them or all three of them if the seasonal applies, and determine which one works best for you.
Check the chat. I'm not showing any up here, but I think there might be some.
Hold
More.
on. More chat. I think it's all
Just all announcements of who it is that we've got.
all the wonderful people here.
Okay, perfect.
Okay, so now let's talk about the exceptions. So if you had an employee that you furloughed or laid off, and you offer them their position back and they refuse to come back, that is an exception. You don't have to take a deduction for that. You should still attempt to hire another qualified person other than that employee specifically. If you have to terminate somebody for cause, then you can also not take you can take an exception for that. So you find out somebody lied on their hours and you terminate them, that's for cause, then you're okay. Or if they voluntarily resigned. So there's also if someone voluntarily requested to receive a reduction in hours. Maybe you have a mother who needed to stay home with her children because of the school closures. If it was voluntary, then you don't have to take a deduction for those reduction in hours. So those were the exceptions, and these are called the safe harbors. So if you're unable to operate during the covered period the same as you did before February 15th, due to compliance to government, national, local, any government entity that's requiring you to be in compliance with certain health guidelines, then you don't have to have a full-time equivalent reduction. So the best example I can give you is restaurants. That's because they may have had 10 full-time people before COVID. After COVID, maybe they can only have half of their dining room open due to restrictions of social distancing. And in that case, they would have a safe harbor for the amount of full-time equivalents. The other safe harbor is if you reduced your full-time equivalents between February and April, you didn't have any additional reductions from April to now, but you restore all of your full-time equivalents either at the date you submit forgiveness or December 31st. So maybe you are a restaurant. Well, so maybe you closed because you're not essential business. When you reopened, you couldn't bring everybody back, but after school started, you brought everybody back. Or if by December this is all blown over and you restore your everybody to their rightful position in December, you can still get 100% forgiveness. So qualified expenses, 8 weeks versus 24 weeks. whether you take an 8-week period or a 24-week period is going to be up to you. There's many people that had budgeted to spend it within the 8 weeks because they may have already gotten to their 8 weeks before it was even extended to 24 weeks. There's also particular clients that I'm aware of that they know that they're actually going to have to do a layoff later in the year or pretty close to now because no more jobs are coming in. And so they've chosen to do 8 weeks because they actually might get less forgiveness if they try to extend to the 24 weeks due to some of these full-time equivalent requirements, etc. So just be aware of the 60-40 and then be aware of what's going to disqualify you for 100% forgiveness so that you stay away from that information. So there's two. Let's have a chat. We will work with Chris and Southern Utah Home Builders to get you the PowerPoint. Absolutely. This slide, I will say, is a lot. So definitely look at it when you get a copy of the slides. What I want to show you on this slide is how, if you have some of these reduction in loan forgiveness, how they can, what do you want to call it, magnify themselves by just going from an 8-week period to a 24-week period. So in this first example, we reduced their salary, and it was more than that 25% threshold that Chad talked about. So if I'm doing forgiveness and I'm able to fit it in within the 8 weeks, I only have a $400 amount that is not forgiven. However, if I go to the 24-week period, I have a $1,200 amount of loan forgiveness that is not forgiven. So be aware of how choosing between those periods may or may not cause you a lot of heartache. Okay. So some of the things that, some other programs that are going on at the same time as the Payroll Protection Program are the Extended Family Medical Leave Act and the Sick Pay Act. Those are government sanctioned paid time off. If you're not aware of these, reach out to your payroll people, reach out to us, do some research on the web. Those are programs that allow the government to help you pay for sick pay and medical and extended family medical leave in particular circumstances. If you are paying people these type of wages during the same time that you're using your Paycheck Protection Program loan, those wages are not covered. So if I have John who makes $15,000 during the covered period, and he also took $1,600 of COVID sick pay, the only amount of wages I can include in the payroll costs are the $15,000 minus the $1,600, which would be $13,400. Okay. I received $3,200 self-employed. I'm the only employee. I haven't taken a paycheck since I received it. So if you're truly self-employed and you file a Schedule C, you don't have to prove the payments to yourself, is what I'm being told by most lenders. It's kind of almost like automatic forgiveness. If you're an S-Corp owner who's self-employed, you do want to make sure that you still give yourself your traditional salary to meet that requirement of paying yourself the amount of PPP.
The other one was just asking if there's an email to ask questions that fill out the forms.
I'm happy to help. I'm happy to help. Our emails will be on the last part of this slide, or you can look up my email on the website. We have a team here who does it, so if I'm not able to answer your question specifically, I might push it off to one of my team members. But yes, we're happy to help. You can also ask your lender. Most lenders are going to have a pretty good feel for what they require, because there are slight differences between each vendor. Okay, payroll tax deferral. Don't confuse this with the payroll tax holiday that Trump just put out a couple weeks ago. Payroll tax deferral is actually for the employer to be able to defer their Social Security payments until 12/31/21 and 12/31/22. So it's just deferring them, and it's only the employer side. So the original rule on this said that if you requested forgiveness, then you had to stop deferring that. And the new rule says that you can continue to defer all your employer required Social Security payments from, I believe it was March 15th through the end of the year. I could be wrong on that first date. So the next thing is the EIDL advance or grant. So another program that was going on the same time as the Payroll Protection Program is called Economic Injury Disaster Loan. This is one that you would have had to go directly to the SBA's website, and you clicked on there whether or not you wanted to receive this EIDL advance or grant. If you did receive a grant, it could be anywhere from $1,000 up to $10,000. You can't receive 100% forgiveness and your grant. So you'll see on the top of the PPP forgiveness application, it will ask if you received a grant or not, and you need to put that on there, because that will actually reduce the amount forgiven. They just don't want people double dipping. They don't want to give you $100,000 in forgiveness plus the $10,000 grant. They're saying we limit you to $100,000 of free money. Any questions?
Okay, we are wrapping this up. There are some tax implications for the forgiveness of PPP loans. Expenses reimbursed by a forgiven PPP loan are not deductible. When Congress rolled out the PPP loan program, they said that the forgiveness of the loan proceeds would not be taxable, which is correct. If this were true cancellation of debt income, and it was forgiven debt, the forgiven amount would be subject to ordinary income tax rates. And they said, well, it's not going to be taxable when it's forgiven. However, in my opinion, they did not consult with the IRS and the Internal Revenue Code, which says that if any debt is forgiven, then the tax attributes associated with that debt must be reduced if we're not going to pick that up as income, the forgiven debt as income. So the forgiveness of PP loan proceeds are not taxable, but the qualifying expenses for which those loan proceeds were used will have to be reduced on the books of the business. The example is company receives $100,000 of loan proceeds. They spend the entire amount on qualified expenses. So the $100,000 is forgiven. That forgiveness is tax-free, but the company must reduce the payroll expenses and the other expenses, whether it be rent, interest, utilities that are associated with that. They have to reduce those on their books. So therefore, if you go around to the beginning, that $100,000 is taxable. Any questions on that? All right, what happens if you received the 100,000 or 10,000 your PPP? Are you qualified for $90,000 in forgiveness? Yes, if you met the other thresholds of spending at least 60% of the funds on payroll related costs and the remaining 40% on the interest, rent, and utilities, then yes, that $90,000 will qualify for forgiveness and you don't have to repay that back. Okay, perfect. Any questions on that? You know, this does bring up an interesting situation with how you're going to report this on your tax return. And, you know, you can consult your CPA on how they want to do that, whether it's going to be a reduction of those expenses on the tax return itself, and we'll keep track of that reduction. If you're using QuickBooks or another accounting software, we'll keep track of that separately. That will be entirely up to you and whoever's preparing the tax return, how you want to report that. But just know, in the end, taxable income from that is going to go up by the amount of the forgiven debt. This is just, so qualified business income deduction, the QBID. I don't know how many of you are familiar with this. If you're using a CPA, they're obviously familiar with this. It's a very narrow segment of our business owners who this will affect, but because these expenses paid for using the PPP loan proceeds are deductible, are not deductible, the business has the option to allocate to a certain degree what non-deductible expenses to use the forgivable funds for. We obviously have to meet the 60% payroll cost threshold. However, if the business has enough non-payroll costs to cover the remaining 40%, the business should reduce those costs instead of payroll costs. And the reason why, so you could have spent 80% of the loan proceeds on applicable payroll costs and also have enough non-payroll costs to cover the difference, so that you're only deducting 60% of those, or you're reducing your payroll costs by 60%. It's a little bit confusing, and like I said, it's a very narrow portion of our business owners that this will relate to. The QBI details are, if you have an owner who is married filing joint and his total or her total taxable income is over $415,000, then with a qualified trader business, which most of the businesses that are participating in SUBA are qualifying trader businesses, if their taxable income at the individual level is over $415,000 for married filing joint, or over $207,500 for those in the other categories, then they will be subjected to limitations on the QBID on their tax return. If they're in a specified service trader business, I'm not going to get into that, but accountants, attorneys, your white collar, typically white collar businesses, they are in that, and the QBI is phased out to 0. The limitation, if you look at the bottom of the slide, if the owner's individual income is above that threshold, the QBI limitation is the greater of 50% of the qualifying wages, or 25% of qualifying wages plus 2.5% of the basis of qualified property. So it really is imperative that we look at the total amount of forgivable expenses, including payroll and the other non-payroll expenses, to make sure that if, as I said before, if we have enough expenses to get up to the 40% of the non-payroll related costs, and we can keep the payroll related costs at 60%, we want to reduce just those payroll costs up to the 60%, because they will be limited or subject to the limitations on QBID. It is a little bit complicated. If you do have other specific questions on that, you can shoot me an email on that. If you do have a CPA, obviously you can contact them as well. But before that tax return is finalized, we'll want to make sure that we are maximizing the QBID for that individual.
So a question that came through was, is the use of PPP funds to cover employer payroll matching costs, like state, federal income tax, Social Security, and Medicare forgivable? So payroll costs are considered gross wages. So that's, if you pay somebody $1,000 salary and then there's Social Security, Medicare, federal withholding, state withholding taken out, it's the $1,000. So it's actually the gross amount. And then the employer matching on Social Security and Medicare are not considered a payroll cost. So that's a definite no. But the state unemployment is, so anything you pay to Department of Workforce Services on those same $1,000 in wages, any company paid contribution to retirement, that may be a 401k, an IRA, but that's just the company side, not anything that's deducted from the employee's check. Company paid health insurance premiums, vision insurance premiums, dental insurance premiums. Those are your big items. So, and not workers' comp. Workers' comp is not a payroll cost in this situation.
Okay, thank you, Candace. So the determination with QBI limitations, if they are applicable to your business owners, it will generally be more beneficial for a business that received that loan to use the 24-week covered period rather than the 8-week covered period, because they'll be able to spend more of the loan proceeds on the non-payroll related costs, rent, like we've talked about, rent, interest, and utilities. So deadlines and due dates. Do you want to handle this? Okay. One item I would like to note is we are dealing with the SBA. We're dealing with government entities, and we're also dealing with banks and lenders that are going to be bombarded with mountains of paperwork. Going back to the expenses that we're going to reduce on the tax returns, we'll want to make sure that we have that set in stone. And one of the reasons is I fear that we will be going past the normal corporate or the normal business deadline of March 15th of next year to file these 2020 business returns in a lot of cases. And my fear is, as you can see on these deadlines and due dates, that we may be bumping up against that extended due date for business returns of September 15th of 2021. So one point is we'll want to get these loan forgiveness applications in as soon as possible. And two, we'll want to determine the reduction of expenses, what that's going to look like as soon as we can after the end of the year. Candace?
Okay, so when do you have to have all this done? So if my 10 months is your deadline to think about in your brain. So if the end of my 24-week period ends up being November 1st of this year, 2020, then I have clear until September 1st of next year in order to file my forgiveness application. So we do have time, but there's also other considerations as well. So you don't have to start making payments until forgiveness is issued. So once you turn that application into your lender or your bank, they have 60 days to review that application. ask for additional documentation, and then they have to submit it to the SBA. Once the SBA receives that, they have 90 days to review it and either approve or deny it. I don't really know how it's going to work. If something is denied, if there'll be a grace period to submit new stuff. I don't know those details yet. Sorry, this is a moving target. It always has been. So overall, you can see that if you submitted at the very last you could, which would be September 1st of 2021, your lender would have till November 1st of 2021. And then the SBA would potentially have till February 1st of 2022. So if you're like me and you don't want to live 2020 over again because of COVID and everything else that went on, there's benefits to waiting to seeing more guidance if you have particular circumstances that haven't been clarified yet. But if you have all the information you need to get your 100% forgiveness, I would say do it sooner rather than later.
So the question was, but interest would accrue from the initial receipt day of your PPP.
Yes, your interest will still accrue from the original receipt date. So if you end up without getting 100% forgiveness, you're going to have potentially a year to 2 years worth of accrued interest that will be due. At the very end of this, and we'll get this slide out, there is some helpful links. This is where the easy application is. This is where the full-blown application is. This is the frequently asked questions regarding loan forgiveness. This is the frequently asked questions regarding the Paycheck Protection Program as a whole. There's different answers in both, so sometimes you have to check both places. Here's another article with the forgiveness tool. I know a lot of banks are sending out spreadsheets you have to complete, and most of their applications that I've seen have been the exact application from the SBA. So questions. So I was asked to repeat what we talked about for what payroll costs include. So payroll costs include gross wages. So that's before any deductions for anything, any tax deductions, any voluntary deductions. So that's the $1,000 of gross wages. If you have state unemployment tax on that $1,000 of wages, then that would be eligible. So that may bring you up to $1,010. Then you would be able to put any attributable health insurance, dental insurance, vision insurance that are company paid premiums. Retirement plans. So if you have a 3% match that the company pays or something like that, those are eligible to be considered payroll costs. Did I miss anything?
I don't think so.
Any other questions?
So we know that this is a lot of information, and we know that there will be more information made available. They're trying to clarify a lot of the questions as fast as they can. It is a moving target still, but we're going to continue to receive updates. I don't really want to throw rumors out, but I will. One of the items that has been tossed around with the small business owners associations, et cetera, with the AICPA and others is a potential automatic forgiveness for those companies who received loans of $150,000 or less. I know Congress will be back in session, in September. We'll see what happens there. I'm not necessarily hopeful, but there is the potential for that to happen, and we'll keep people posted on that as well as we get updates. So thank you for being on with us today. Like Candace said, you do have our contact information there if you do have additional questions. And we appreciate you being on with us today. Chris?
Yes, thank you.
Have a wonderful day.
Thanks, you too. Just make sure everybody puts their name and company name in the chat if you need parade points anyways.